What if I told you that there are two ETFs that could pay you over 10% in annual income while still giving you exposure to the biggest names in the market like Apple, Microsoft, Nvidia, and Amazon? Sounds too good to be true, right? Okay, what are these funds? Let's start with the basics. The SPYI, which is the NEOS S&P 500 High Income ETF. This tracks the S&P 500 while generating income through a covered call option strategy. And what is the second fund? The second fund is the QQQI. The QQQI is the NEOS Nasdaq-100 High Income ETF. It does the same thing as SPYI, but for the Nasdaq-100, meaning you're getting exposure to the biggest tech and growth names in the market. Before we jump into how these funds work, let's first take a look at the holdings. For SPYI, it's 34% technology, 12.73% financial services, and over 11% communication services. You're going to see some of the biggest names here: Nvidia, Apple, Microsoft, Amazon, Alphabet, Meta, Broadcom, Tesla, and Berkshire Hathaway. Now, if we look at QQQI, it's going to be a little more technology based, but let's take a look at their holdings here too. Their holdings are, let's see, almost 51% technology, and then it goes down from there. But they have all the same companies: Nvidia, Apple, Microsoft, Amazon, but in bigger percentages. A lot of other sectors, including communication services, consumer cyclical, consumer defensive, healthcare, industrials, utilities, and so on. Okay, now here's where it gets interesting. The distribution rate on both of these ETFs is over 12% APR. The management fee is 0.68% on both, which is not too bad. The yields do fluctuate, so always verify your numbers on the official neosfunds.com website. These aren't typical dividend ETFs. The income comes primarily from option premiums, and it's not just company dividends. And they pay out monthly, which is great if you want consistent cash flow. Okay, so how do these funds actually work? Well, there's a covered call strategy, which means the fund owns the underlying stocks like the S&P 500 or Nasdaq-100. They sell call options on those holdings. When they sell those options, they collect a premium, and that premium is what gets distributed to you as income. What is the trade-off? The trade-off is you cap some of your potential upside. If the market absolutely rips higher, these ETFs won't capture all of the gains because of the options they sold. But here's the thing. NEOS uses a flexible, active approach. They're not mechanically selling calls at the same strike every week. They manage it tactically, which helps balance income generation with upside participation. All right, let me tell you why I personally hold both of these funds. The first reason is the monthly income. I love the idea of getting paid every single month. It's great for reinvesting or covering expenses. Reason number two is diversification of income sources. Most of my portfolio is focused on growth. These ETFs let me add income without abandoning exposure to top-tier companies. Reason three is tax efficiency. NEOS structures distributions in a way that can be more tax efficient than traditional income ETFs. And the last reason, number four, is lower volatility. The options premium act as a small buffer in flat or slightly down markets. These ETFs can actually outperform the QQQ or the SPY. Every investment has risks, and I'm going to definitely tell you the risks in every single video on every single ETF. With these funds, the risk is the capped upside. In a massive bull run, you will lag behind the SPY or QQQ. As you can see from this chart, the SPYI, this is from August 30th of 2022 to the end of 2026, or the end of 2026. So they're showing what the return should do. 60.44% for SPYI, and it's got a 12.2% distribution rate. And if you just hold SPY, you would have 80.32% gains. The other risks are the complexity. Option strategies aren't for everyone to understand, and past performance doesn't guarantee guarantee future results. Also, the distribution variability, that 12 to 14% yield, it can fluctuate month to month based on market conditions. And also, it's relatively new. QQQI launched in 2024, so we don't have decades of data to analyze. These aren't set it and forget it funds. You need to monitor them and understand what you own. So who should consider these funds? I would say it would be income-focused investors who want monthly cash flow. It could be retirees or near retirees looking to supplement income. It could be growth investors who want to add an income layer without going full value, and anyone who wants S&P 500 or Nasdaq exposure with an income twist to it. If you're purely chasing maximum growth and don't care about income, stick with SPYI or QQQ. So that's my breakdown on QQQI and SPYI, 2 ETFs I hold and 2 I think are worth researching if income is part of your investing strategy. None of this is financial advice. Please like, subscribe, and comment which ETF you want me to cover in the future. Thank you for watching. God bless and have a great day.